Sounds good. All right, so we have our monthly investment committee webinar today. Typically, we have a guest for you guys, but this month's edition is just going to be an update from the investment committee at Greenridge. Given that it's been a pretty impactful month in markets with the election, a lot of things to touch on this month. So we're keeping it just us. On the agenda, we're going to give you guys a market update, share the market vitals for this month and this year, touch on some recent news stories that we've seen in markets. And then we also want to touch on some of the hot button topics that we saw regarding the election and how we're kind of analyzing those topics and how we expect those to play out. So we got an interesting lineup for you guys today. And then we'll have a question and answer section. If at any times you guys have questions, feel free to drop those in the chat and we will get to those as soon as we see them.
One just quick note, when I was on earlier as a non-panelist, I tried to go into the chat and the chat was disabled. So whoever's head of chat options should make sure that people can post in the chat.
I will make sure the Zoom master is notified.
Awesome.
Zoom master.
Luciano's yelling, I got it.
That's great.
Yeah, team player.
Executive director.
All right, so taking a look at the market vitals so far in 2024 and over the last month, S&P is up 24% so far in 2024. If we look at the last month, it's relatively flat. So we saw in late October, the S&P came in a little bit. There's a little bit of a decline leading up into that election. As we talked about before, the market loves predictability. So leading into a big election, it's not atypical that there would be a little bit of a drawback. But once that election occurred, we saw a big rally in the market. So over the last month, it's been flat, but there's been a lot of movement up and down in that last month. I think one thing to take note of when we look at these major indices over here to the right in the 1 month performance, the Russell 2000, which is a small cap index, saw a pretty big increase over the last month of 1.1% when you compare it to some of those other major indices. And a big reason for that is looser regulations, the expectation for looser regulations and M&A activity that tends to benefit those small cap companies. So that's one reason why we've seen that number kind of lead the way. And then
the focus on domestic, right?
Focus on domestic as well. And that's why we're seeing Vanguard Total International Stock Index down 4.4%. So that's another number that jumps off the page right there. That US first mentality that kind of comes with Trump winning that presidency and the possible tariffs that he's been talking about enacting, how that affects foreign companies.
Yeah. I mean, I think kind of going off that point too, towards the next table with growth versus value, you're kind of seeing growth still lead the way, especially on the year-to-date numbers. You can see, the first one, the iShares S&P growth, that being up about 31%. But as you start to get to the bottom of it, you're starting to see some of that small cap and mid cap continue to, show positive momentum, with the 1 month on the small cap value being almost 4% and then growth being 2%. So I think that would be kind of interesting to see too, how that trend continues. If you start to see some of the small and mid caps catch up, and then also on the lower end, if you kind of see the value outperform a little bit of the small cap growth, just with a little bit of the difference of the companies in there.
Yeah. And a big part of that's financials, right, Brando? That value, the small cap value, there's 25% in the financial industry. That's been an industry that's really taken off since that election, with the expectation of looser regulations and M&A activity. Financials tends to do really well in that space.
Yeah. And you've seen,
just to clarify, we are talking about the results of an election. So I don't want anybody to think that there's any underlying tone that we're happy, sad, or in between. This is more just delivering facts. So, we are talking about the direct results of what transpired and what will happen at the turn of the year in January 20th.
Yeah. Another thing to note, the treasury rate in the last month up about 8%. So year to date, that's about 14%. Look at what's happened over the last month. Inflation numbers have kind of stalled out on their decline. So for a couple of years, we were seeing a steep drop in those inflation numbers as interest rates were being hiked up. Now that inflation, the CPI is sitting around 2.6% as of the last reading. We just had a PPI report, which is the producer price index. That's sitting at 3.1% year over year as of the last update. So those inflation data prints have led the market to believe that maybe rate cuts will be slowing down in the coming months and in 2025. And I think that's also exacerbated by the election and what the expectation is around what tariffs might do to inflation and the economic growth that is expected. So that's one thing that we've seen over the last month is that 10-year Treasury rate just continuing to kind of tick on up 8% over that last month. A lot of times we also see the US dollar kind of moves hand in hand with that 10-year Treasury rate. I think as I mentioned in last month's webinar, when the US Treasury rate for 10-year is moving up, it seems to be a more attractive investment for foreign investors, especially US Treasury rate is something that treasuries have never defaulted. So when they see that attractive investment opportunity in the US and that US first mentality that came along with the election, it makes sense that that US dollar strength is also ticking up.
Just for reference, Sean, because I think, as we talk about changes in the Treasury rate and 14% and 8%, it's, sometimes hard for people to conceptualize when a percentage change in a percentage in itself. So just to add some context, the 10-year yield started the year at 3.9%. It saw a high of 4.7. This is right around April, May. It saw a low in September of 3.6 and is currently at 4.4. So it is 0.5% higher than where it started on January 1st, but it's had a wild ride all the way through the year, kind of up early, down when people were worried there might be a recession, and then up again as we got closer and closer to the election.
So and this is considered kind of like your risk-free rate, so to speak. To some degree, the 30-year mortgage is somewhat correlated to this. So when we look at kind of the directionality, to keep that in mind.
Yep. All right, let's take a look at some of the recent news stories that we're seeing. One of them upcoming tomorrow is NVIDIA's earnings. So that's always a big day since NVIDIA has been such a big player in the AI space over the last couple of years. They are reporting tomorrow after the market closes. And many people deem it the single most important company for investors to kind of keep track of in terms of earnings. It kind of acts as like that North Star for how is the semiconductor industry doing? How is AI progressing? A lot of people have their eyes on that NVIDIA earnings, so I'm really excited to see how that plays out. There have been a few concerns in the last few days about overheating on these Blackwell GPUs that NVIDIA is using in its data center, so there is some concern. But generally, sentiment is pretty high for NVIDIA still. I think the expectation is that they're going to continue to grow at the pace that they've been growing.
So NVIDIA, just, a little more color. NVIDIA is, basically more valuable than Apple at this point. It's mostly driven by AI. And I heard something interesting that their market cap of NVIDIA is bigger than Germany, France, and the UK combined.
That's wild.
So
3.7 billion.
News.
Yeah.
Talk about why it's news. That's kind of why it's news. It's more than just a household name.
Yeah. Yeah. I think something else too important for it is kind of the last point there of the company's guidance and forward outlook of, what are they saying coming down the street for, the next quarter and the next year. And then also what are, other companies saying like AMD and kind of looking at, the similarities or differences between the two guidances or, what troubles or what similarities they're kind of seeing together or, if NVIDIA is, really outpacing compared to somebody else and, kind of looking at it as a whole and how that, affects almost the sector after the earnings report and what they say have to come.
Yep, that's a good point. I think another interesting thing is like how things like tariffs will affect NVIDIA. If you look at China, there's some pressure in China to start using more like domestic AI solutions. So if we start putting tariffs on Chinese companies that are trying to export goods to the US, they might end up doing the same thing back to us for things like NVIDIA chips when they can use their own domestic supplies there. So it'll be interesting to see topics like that with tariffs, how that ends up affecting companies like NVIDIA that rely on some of those international markets for their growth. The next news story we want to touch on is just the Federal Reserve may end up slowing their rate cutting process. We touched on this a little bit on the last slide. With that inflation data that we've seen coming out, CPI at 2.6% year over year, PPI at 3.1%. That next Fed meeting is scheduled for December 17th, 2024, so a little under a month away. And if we look at what the market's been pricing in terms of these rate cut percentages, before the recent inflation data release, it was at about 20% chance that the Fed was not going to cut rates in December. That has since ticked up to 40% chance that they're not going to cut rates in December. So directionally, we are moving to an atmosphere where there's likely not going to be as many rate cuts. At least that's what the market is starting to price in. So that is something to take note of as we get closer to that December 17th date. How those percentages continue to shift will be interesting.
It's also going to be interesting what the voice out of the executive branch is going to do to try and influence Powell and that rate cutting process. Yeah. I know that he's standing pretty strong, saying that they are working, they are to work independently, which is really their goal. But we saw in the last 4 years that he was in that seat how much influence his voice had, and it's going to be interesting to see how that unfolds.
Yeah, I mean, we kind of have that in a future slide too coming up of a little bit more details of will anything change based off of what he said previously, or should anything change based on some of the tariffs and inflation data.
Yeah. So Brandon, what are some of these big topics that we're seeing with the election wrapping up? What are some of the things we're kind of looking at?
Yeah, I mean, well, there's a lot of topics we could have covered. I think two really important ones are tariffs and then regulation changes. One with the tariffs, the inflationary concerns over it. Also the Fed, rate cuts, will they kind of continue along the path, or does something end up changing? And then also what will be the final outcome? I think that kind of plays a part in both of them of, what's being said, or, what's been almost a running point versus what will actually happen. I think there's a bit of a, distinction that might happen there. And then also with the regulation changes, I wrote big tech winners, but, Google, for example, who's had some antitrust lawsuits, you can see them being a little less scrutinized. And then similarly, how does this affect the M&A process? And then also, timing and complexity of some of the regulation changes. And, we have some clips to show as well from different news channels. So, we can see these, see what other people are saying, and then, also have a little bit of our own commentary.
Yeah, sounds good. So I think the first thing we want to touch on is these tariffs. And I'm going to pull up the first clip from Yahoo Finance.
Can we, does it make sense? Will this cover what a tariff is going to do? Does this clip cover that? Like what is a tariff? How does it impact? Or should we put color on that first?
I think we should put color on that first. Yeah. Yeah. So tariff is when the government is putting a tax basically on a company that is looking to import goods into the US. So if there's a car that's being imported from China into the US, the United States government is basically putting a tax on China for being able to do that. So it costs the Chinese company more to sell that car in the United States. And oftentimes you might think it's being put on the Chinese company to cover that cost, but oftentimes they end up raising their prices. And that ends up kind of being passed through to the consumer as well. So it can oftentimes be a split.
Sorry, Sean, let me just, if you don't mind, I just want to jump in and make that a little bit more concise.
Got it.
U.S. puts a tariff on a good being imported from a particular country. If that good, let's call it French wine, so we're not getting too much into the China.
Sure.
U.S. wine, you buy a French wine in the United States. That French wine is $20. If the U.S. puts a 20% tariff on that wine, it will cost you, the consumer, to buy that $24. French winemaker get 20, US government get $4 in tariff tax. It is a tax.
That is not a tax on France, though.
Correct. It is a tax that US
Tax on the
consumers
consumer.
pay,
Correct.
not a tax any other country pays. Now, does it hurt French wine sales? Well, yeah, your American comparable wine, if they were both $20, will only be $20. Your French wine will be $24, $20 to French wine producer, $4 to US government in the form of tax. So we get more tax revenue, the US government, but it is the consumer making the conscious choice to buy French wine instead of US wine that is ultimately driving the flows of those tax. The French wine producer might sell less wine as a result, but that's not a direct corollary if people think that French wine is worth $4 or more than that comparable $20 US bottle.
So if I could just add a little color, let's use France for instance. If we import a number of items from France that we don't make domestically, then there is no other option other than to find new manufacturing that gets created domestically to now become that alternative option. So if we don't make any Bordeaux, and Bordeaux is only a French wine, then there is no comparable Bordeaux. We have to go to a different blend. And for some parts of different industries, we'll just choose something different. You have to pick it. Inflation will kick in because you're going to need it anyway. So that's the interesting part about the tariffs. A little more complex than I think what most people, think when they're watching the news. So, yeah, sorry, I didn't mean to derail that on you, Sean. I just wanted to make sure that whoever was
definitely
listening had a
helpful
little
to give that context and a basic overview of those tariffs. So this clip goes into what Donald Trump's actual tariff proposals were when he was running. So we'll just watch this short clip. It's about 40 seconds.
Donald Trump has talked about tariffs, as you mentioned, as a solution to a string of problems, also saying during his campaign that tariffs would be a key source of revenue to pay for his agenda. Now, that could lead to a serious dent for average Americans. Trump has repeatedly promised to add universal 20% tariffs on all goods imported into the U.S., 60% tax on goods coming in from China, and we're talking about more than $3 trillion worth of goods being slapped with tariffs. The Peterson Institute for International Economics estimates those tariffs alone would cost the typical American household over $2,600 a year. Another study by the Yale Budget Lab puts that estimate even higher, saying Trump's proposed.
All right, so yeah, I think that gives a pretty good overview of what Trump's proposal is, putting 10 to 20% tariff on all U.S. imports, and then focusing a little bit more on China, up to a 60% tariff on those Chinese imports. It is important to note that this is just what his proposal was when he was running during his campaign. So this has not been enacted. We have no idea if this is going to actually be what ends up being put into place. It could be totally different by the time it gets through all the proper channels. But the estimate is that it will end up costing consumers an additional $2,600 a year.
Yeah, I mean, I think those are, is an important takeaway of one, what will be the final, kind of said and done number. And then also kind of looking at like what industries kind of face the biggest impact. I mean, just an example of looking at, Nike, who has large production of goods over there, and same with kind of electronics and Apple, where you have a lot of production coming from, one spot like China. And then even with it, it's including all U.S. imports. So it'll be interesting to see kind of how companies look to lower costs if they're in China, if they try and move somewhere else, or if they try and move domestically a little bit more to the production to get away from some of those tariffs, and really see what the cost, will be at the end of the day.
Yeah, one also thing, because I think, ultimately what that's saying, if it's going to cost Americans more money as a result of tariffs, which is what that clip was, kind of hammering at, it's the risk of higher inflation. And that, one of the issues that we see is people will say, well, that was a campaign promise, but is it just a posturing move? Is it just a way to kind of get things for us? Have China give us better treatment towards intellectual property rights and things like that, which have been an issue that corporate America has been, arguing for and making a lot of noise about. And those are, things that we should, in other words, there's some possible positives from it. It's not just all potential cost, but there's some negotiating tactic in there too. So we'll see how that all kind of works out. But on its face, that clip was really harboring on, if you were going to the polls and you're, worried about inflation, tariffs are not going to help your inflation situation. It's very hard to see how prices come down with tariffs.
I think that brings us right into our next clip, which is the impact on rate cuts based on that inflation change. So this is about another 40-second clip.
Yeah, so we think that the election of Trump and the likely imposition of tariffs really is a game changer for Fed policy in 2025. We still expect the Fed to cut in December, although I think there is some question as to whether it will follow through on that. And we expect then a cut in March, and then we think that's going to be it for 2025. And that's really due to the fact, one, that we are already seeing a decent amount of strength in the economy. And then two, that we think that the tariffs are likely to add an inflationary impulse that hits by the middle of 2025 and forces the Fed to not cut as much.
But David, when you try to...
And that will affect how Fed does rate cuts or rate hikes. So
yeah, I think it'll be interesting to see kind of them talk about the future too during the next meeting. Kind of with, the risk of inflation going up, whether they will kind of be a little preemptive in a sense of leaving rates where they are or a little bit higher, you could say, to kind of combat the, future risk, or if they're still going to continue to go off the current data and, wait to see if there's any changes in it and then kind of decide where to go, or, kind of already taking into consideration, one potential risk.
Yeah, another thing just to kind of highlight as we're looking at this is we don't know how this is actually going to play out. Yeah. We are just as curious to see what if this is actually just jawboning, what if this is actually going to be implemented. And one of the things in those two clips that we see is it ultimately caused a lot of concern that rate cuts will not be able to kind of remain on the same path prior to the risk of tariffs. And then the other thing is, does it increase inflation, which again is, part of the rate cut story. These two things are widely communicated. Like, it's not like this is, fringe information that is hard to find. It's not like you got to dig under a pile of rocks to find economists who are warning of inflation threats as a result of tariffs. This is pretty much 70+% of economists who have commented on this, including large economic research houses, have made it very clear that they think the threat of tariffs are going to be inflationary, and if they are followed through, that it will be inflationary. So I think that most of the people in the Trump administration have a TV, and they probably are hearing some of these things, but whether or not they've kind of walked themselves so far that this is a policy that they're going to have to enact, the then question is whether or not they're responsive as the response from Americans who are paying potentially more like $2,600 if they, respond in kind. And just for a reminder, if we remember, Trump put a lot of tariffs on farming goods coming in, and a lot of countries responded in kind. This was back in 2018, 19. They responded in kind with tariffs on American farming goods. And it ultimately resulted in the US government doing a bailout on farmers for $1.8 billion, because that's how much lost revenue they had, especially soy crop American farmers. There was a big impact in their ability to sell abroad as a result of tariffs that were put on American producers of agriculture goods based on those agriculture tariffs we put on. So this is like, it gets complicated. There's a lot of stuff. Even as I talk about it, I feel like I'm doing a tongue twister. So there's a lot of moving parts here, and we'll really see how people respond, whether or not the administration takes note, whether or not they follow through, whether or not this is just jawboning. We're all kind of on pins and needles to see, but we're starting to see that in that 10-year that Sean highlighted earlier, that started to move up as the election got closer and followed through. This is something the market's watching, it's aware of. This isn't hiding in a closet. And we are also watching closely to see how this ends up playing out. And that could have a big impact on how we think about how portfolios should be allocated. So we just want everyone to know we're clued in on this one.
Yeah, and you know, to the point of where we're at right now in terms of the incoming administration is we also don't know what is rhetoric and what is reality. And one of the things that we are constantly saying is we are not oracles. We look to see what's going on. We observe the markets and we make adjustments as needed. And this is exactly where we have to be patient. We have to see what starts to transpire before we make any changes. Because if they don't happen and the market overcorrects in an assumption that it is going to happen, we're going to find ourselves mispositioned. So, you know, we're just staying observant, very observant.
Yep. Another big topic we want to touch on is that future regulations and how that may impact mergers and acquisitions, which in turn impacts the stock market a lot of times. So we have a couple of clips here that we want to share with you guys. First clip is about 30 seconds here.
The way. But you know, M&A deals take more time.
Yeah.
Right? It's not like the equity markets where day to day these changes in spot price have a real impact. You know, our deals can take months, sometimes years in the making. So I think it's more about what's the trend line and what are expectations. And I do think that will manifest itself in activity for sure. And you alluded to antitrust. I think that's going to be also a you know, a supporting factor in terms of, you know, moving away from what was a pretty restrictive stance with respect to regulatory policy.
Which sectors are?
So yeah, as you just mentioned, I think it's been really restrictive in past years on antitrust. There's been a number of different antitrust lawsuits that we've seen come out against Google, against Apple, Amazon. So if we begin to see looser regulations in that space, it could give a lot more freedom to some of those big tech giants to focus a little bit more on innovation, and then open up the potential to maybe acquire some other smaller companies without as much fear of that antitrust.
Yeah, and well, antitrust comes with the assumption that we're talking about big companies getting bigger. We're not talking about day-to-day small M&A transactions on the street with interest rates where they are. We're talking about big companies that have a lot of cash on hand that are going to be assuming or acquiring smaller companies.
Yeah, I mean, I think another point too is, you know, as for like the deal making and the timeline behind that, I'll be curious to kind of see too if we start to see, you know, more mergers and acquisitions kind of come up from where they are currently. Like we've had a lot of M&A attorneys and investment bankers on in the past talk about where it was kind of during COVID, and like how quickly deals were getting done or quicker. And there was just more, but they've come to a little bit more of a normal, you know, level, you could say now. But I think, you know, what will happen with that, if that will kind of be able to pick up more again, and just something interesting to see from, you know, maybe not so much the Amazon and Apples, but a little bit on the smaller market side.
Yeah, our second clip here is actually from IBM's CEO or chairman. So it'll be interesting to see how like a chairman of one of these large companies is thinking about this. And this is about a 30-second clip.
I think that we are all hopeful that there is going to be a lot more innovation and there is going to be less regulation. Those are both good for business across the board. I always acknowledge we need some guardrails. I always think, you know, at least in the United States, with our system of separation between the judiciary and the legislature, there'll be some guardrails. But I'd say the business community overall, and us especially, are excited that we think there will be tailwinds to the economy going into 25.
Joining us now, we want to bring
So yeah, kind of just echoing the sentiment of the first video, the expectation is that regulations will be a little bit looser. It'll be a tailwind for the economy. If there is more merging of companies and acquiring of companies, typically that is better for the market and better for those larger companies that are making those acquisitions. So yeah, that'll be
Well,
interesting.
one thing that also tails into that, because I think, mergers and acquisitions, and the market certainly likes that. The market likes the idea of companies being bought at premiums, that you could wake up one day on a Monday. We used to have Merger Monday back in, before the financial crisis. It was, you come in and three companies would be taken over on Monday, and you'd see stocks popping by 20, 30, 40% in one day. So there's part of that is the enthusiasm about that. But one of the things also, and I'll just use artificial intelligence, everyone's favorite buzzword this year. Artificial intelligence is California came out with a law around artificial intelligence, really kind of reining it back. It's a good example, right? On one hand, you have people worrying about whether or not, Arnold Schwarzenegger is going to come in dressed as the Terminator, and we're going to have the apocalypse of, machine versus human. And on the other hand, we have the optimism about ChatGPT or all these other automated programs solving problems for us that, making our lives just so much easier. AI doing note taking and all these other, summarizing studies, building websites in 2 seconds. These are all really exciting things, but within that, we have to think about copyright law. We have to think about whether or not this is impacting jobs, whether or not this is ultimately something that should be slowed down and is a security risk or is a potential risk. On the other hand, we got to also kind of think about our position in the global world. If Russia and China are building their own AIs, which they are, do we want to be a step behind them because we overregulated that sector? And so that's one of the things that, regulation is also thinking about, not just the ability to do antitrust, but if we're breaking up Google and Google's focused on whether or not it can keep YouTube or keep its handheld market or keep Android as an operating system, it takes its focus away from artificial intelligence. So part of that regulation not stopping big tech in doing the things that it wants to focus on to remain more competitive, that's maybe a positive there. Its ability for Microsoft to potentially buy OpenAI with its own ChatGPT and kind of create a monopoly around there. That's also something that antitrust isn't sure about. It's fighting with itself about, is it a good thing? Does it make America stronger? Is it a bad thing? Is it unfair to all those other companies trying to build AI software if Microsoft, with its huge balance sheet, can basically just snuff out any competitor by giving it away for free, killing everyone off, and then suddenly jacking up the price, which was ultimately kind of the Standard Oil. This is why we can't let monopolies and oligopolies exist. So there's a lot of considerations as we think about not only just the M&A and what can happen there, but also companies being able to focus on where they see growth and growth prospects, and how those CEOs can then really focus their energies as opposed to always being worried about whether or not the DOJ is going to be putting an injunction or slowing down their ability to do the things where they think the most opportunity lies. So we're kind of balancing those things, and I don't want people to feel like we just want mergers and acquisitions, and that's kind of more like sugar juice and steroids for the market. Whereas some of these regulatory things, if we slow down these companies, it does impact GDP negatively, potentially. It might be good for the long term. There's a long term and a short term here that we're also balancing. Sorry, Bob, what was your best say?
I was just about to say, we are also, you brought it up. We're in a global race, and our job, while we're looking at jobs and we're looking at AI, and people are concerned about, is AI going to take jobs? The hope is that it will, because we're not going to have as many people in the job market to fulfill the open jobs that are out there. So AI as a support to help lift people's positions and assist them in work that will be partially taken over by some AI component, is what we're going to need globally, because there's going to be a global drought of people in the labor force that's going to be needed to be accounted for.
Yeah. Another space worth mentioning in the regulation sector is cryptocurrency. We've seen Bitcoin since the election. Bitcoin just hit 90,000. Dogecoin hit 40 cents for a second. So we've seen a ton of movement in the cryptocurrency space just since the election based off of the expectations of regulation surrounding cryptocurrency. So that's just another thing that's worth mentioning in this regulation space. But let's check out this last clip here. This is about 50 seconds.
The froth under the surface. Do you think that deregulation could create that froth again?
Well, it may be true in the financial institutions that there are few of us left who were there and went through that trauma, but it's not true in the regulatory community. Now, there could be a wholesale slaughter of regulators at all levels and under the Trump administration. I doubt it. And as a result, the regulatory institutions, the Fed, the Treasury Department, the OCC, have deep institutional memory. So I think there's still the experience of that crisis it's muted now over time, but I think people understand that we don't want to get so deregulated as to create risks of that kind of crisis again.
Now let's switch.
Yep.
Yeah.
So
you can go, Sean.
sorry, you go ahead.
I think that kind of goes.
No,
back
you go first. No, you go first.
You want to take it over, you can take it over. I think to some degree, like that goes back to Jordan's point about, finding a balance there in the regulations. It's kind of one thing when you're looking back at when there was a crisis or an event that caused, guardrails to be put in place or regulations to be put in place. So you don't see that type of event again, versus where there's kind of newer regulatory things to really consider and think about what are the impacts, kind of going back to AI in certain companies. What's the difference in the regulatory nature from that versus, some of the prior experiences or events where we've put things in place. So having the balance act between there of not, going so far one direction for deregulation, but then also, having a balance for, future regulations as, the world continues to evolve.
Yeah, one thing I think that we all kind of think about as we get ready for what's going to happen with both tariffs and the regulation onset is whether or not there's going to be nuance here. Or maybe I'm exposing my own personal concern. If we're nuanced, if we're thoughtful, these things can be used thoughtfully, and they don't all lead one way directionally. And I think that was one of the things that Jim Milstein, the head of Guggenheim, who's super smart guy, runs a fantastic organization. He's saying, look, you can't just totally unregulate everything, repeal Sarbanes-Oxley and say, oh yeah, no problems are there. But Sarbanes-Oxley isn't a perfect regulation in controlling banks. It became a little bit too restrictive in some ways, and banks just found new ways to kind of get around it. And so, there's ways to kind of clean up some of these things that are over a decade old, where there's big changes that have happened, whether it be AI or new ways of managing risk on balance sheets, or even new ways banks are handled. Sarbanes-Oxley was made so no banks would fail, and there was no, we're getting away from that too big to fail concern for the government. SVB and Signature Bank failed regardless. And it wasn't because they failed the depository test. It was because social media kind of took over how Silicon Valley thought about its deposits, and all the people in Silicon Valley all used SVB or Silicon Valley Bank. And so if you're all using the same bank and then you hear all your buddies are taking their money out, well, that's how that all kind of transpired. So it had nothing to do with how many deposits they had. It had to do with how quickly people withdrew their deposits and the bank run that transpired from one tweet. And the same with Signature Bank. Signature Bank had a lot of business in cryptocurrency. Well, cryptocurrency has nothing to do with Sarbanes-Oxley's regulations. So when these companies suddenly saw huge outflows and redemptions in their world, Signature Bank was unprepared to really deal with that. And the regulator really had no foresight to it either, despite all these regulations. So these things always need to change and be looked at. But you know, it's in some ways, we can be hopeful that some of those changes will be thoughtful, but we hope that they're thoughtful because, you know, with that, some of these things can have positive impacts that, you know, we can look forward to a better environment for. We do have some questions, by the way, in the chat.
Okay.
Do we want to go to those?
I can stop the
we're at
sharing.
that
That was
time.
our last slide. We do have a commentary that we put out last week that covers a few more of those hot button topics like tax cuts, military spending, energy. So if you're interested in seeing some of those full videos that we use for those clips and also getting access to our commentary, which can be found on our website, you can also email team@grwealthplan.com and we can send out those videos and send out that monthly commentary that we just put out. So you guys have access to that. But for the time being, we'll stop share and go to some of these questions that we have.
Yeah, one of the first questions, this was likely when you were talking about the decrease in the probability of rate cuts in December, is someone mentioned that, you know, oh, it's likely not to be as many rate cuts. Does this mean rates are going up again? And in the short term, I'll take a shot at it. In the short term, I would say no, not at least in the next 6 months. But we would have said probably 6 months ago that interest rates are likely to go down. They're likely to go continue going down, and they're likely to go down from 12 months or more from when they start cutting, which was September. Now that's called into question. They may not cut again this year. They may decide to hold off on cuts, and depending on what things are implemented for the new administration in the first quarter of the year, we may not see many cuts in 2025. Will they go up again? I think we'd need to see a meaningful change in inflation to the upside. And by that, I mean inflation, which is currently around 2.6%, would probably have to breach 3.5.
I would say to get Jerome Powell to reverse course, he'd be less likely to continue to cut, in my opinion, than he would to reverse course and start to raise, to Jordan's point, unless something dramatic happens. Like we don't even know if these tariffs are going to happen. If they do happen, we don't really know how much of it is going to impact our total inflation. And there are economists that are saying, you know, it's going to cost $2,600 per person. We haven't seen what they look like. Could look one way, could look another way, right? Tariffs don't come in just one shape, form, and size. They can come in layers. So I think it's a little too early in the game to even call that. You know, Jordan likes to say we're calling balls, we're calling strikes. Where are we at? And the pitch hasn't even been thrown yet. So
it's fair. Agreed.
Don't worry. Don't worry about it yet. Worry about it later. Don't worry about it now. We don't know enough yet.
The next question, what is the market impact for older investors with a shorter investment horizon? I think a lot of times when you look at the market in those short time frames, there can be a lot of volatility in the equity market. So really positioning your portfolio properly for your specific time horizon is extremely important. And those are the types of conversations that we're here for. Setting up meetings with us and being able to kind of talk through what makes the most sense in terms of your allocation, how you should be positioned based on what kind of financial goals you have upcoming, what that time horizon is. Typically,
you also have to just be observant, right? I mean, a risk-on environment has what would typically be seen as a risky investment really not showing that much risk because it has all the tailwinds behind it to continue. So the likelihood of you seeing a huge change in a downward trajectory for those types of equities are different than if the environment changes. So we have to understand where we are and what environment, and that's part of being the observant. So to Sean's point, is really having a conversation to understand where we are, where we think we're going to be. How do we de-risk so this way you can put your head on a pillow? But how do we also stay engaged enough so that this way we have levers to pull when the time comes to pull those levers, and we're not just running and hiding under a mattress with cash stuffed in our pockets because we're afraid that the world's going to blow up. Because if inflation goes up, cash in your pockets are going to be worth less than if you're perfectly positioned and allocated. And the only way you're going to be perfectly positioned and allocated is if you're engaged in what's going on over the markets. And there's no such thing as perfect, but you know my point. My point is, you know, we have to understand what the dynamics of every change in how it transpires within the market is going to react to your portfolio.
One thing I'd add is, you know, even though this this presentation has been a lot about the political atmosphere, and that's because it kind of is the absolute loudest foghorn in the room. We like to say the expression, don't invest with your politics. What happens, how it flows through the economy and all these things, there's a lot of unknowns. We're also a global world. I mean, even when we're talking about those tech giants, 60% of their earnings are international for many of them. I'm sorry, I should say revenues, not earnings. So we're not always just focused on what's happening around the corner from us. We're not focused on necessarily what's happening just in the US. We have to be thinking about the global world. And there's some other potential positives like a resolution to the war in Gaza, a resolution to the war in Ukraine and Russia. Now, I'm not, you know, from a political standpoint, everyone might have views about what is good, what is bad, what is not. But if those issues get resolved, if we do see some of those things happen, now there may be new things that sprout up. But right now, there seems to be some optimism that those things are going to happen. We've seen a decrease in some of the defense and aerospace sector because there's this expectation that some of those things are going to go away. So
stability is in our favor. Used to be war gets us out of recessions. That no longer is the situation.
Yeah, but I mean, all these things are happening. Like you said, we've got a trend right now which is telling us that these areas are good, these areas are not good, and we're trying to focus on, you know, Jim Cramer likes to say, you know, I'm looking for a bull market. There's a bull market somewhere, and I'm here to find it for you. Is his phrase, and that's kind of what we're here doing. And if we can find,
I don't have a cow, but I can ding stuff.
the bull and the bear, the bull and the bear. My favorite episode of his, by the way, was when he married the bull, like on TV. That's got to be, you know, some of the best TV CNBC's ever had. But
that was a little risque.
It was questionable to have a bull come out in a wedding dress. I don't know if it was my choice that I would do, but it's called Mad Money, so here you got to go. But one of the things I think is, as you said, is there's a combination of your own plan and your need for funds, and then there's a combination of what's going on in the market. And those two things, when they're not necessarily aligned up, there's nuance to it. Just as we're saying, we hope the administration thinks about nuance and is tactful with how it does things. We need to take the same approach as professionals. And it, you know, you'll hear people say, sell it all, buy it all. That's rarely ever the answer. It's more about how do we tweak and fix. We think we got a pretty good engine going, but that doesn't mean that there aren't little ways that needs to change. If, you know, we're going on more of an endurance run, or, you know, we're going on a full sprint around an F1 track. So
yeah, I mean, if we went pre-COVID, people could have made the argument. Listen, I won't make any money in the bank, but at least I know that I'm protected. You know, it's hard to argue against that. But when we're in an inflationary environment like this, there's really no place to hide, to like tuck tail and run and hide.
Yeah. And I think even then, you know, you can think you're in the right place. I mean, on February 27th of 2020, if I told you in the next 12 months, the market's going to be up over 40%, how many people would have taken that bet? You know, while they're shutting down schools and going through.
Even when Hillary Clinton didn't win and the market anticipated her to win, the market had a little bit of a tick, and then it continued to go up, and people were trying to find their entry point. They're like, when do I get in? When do I get in? And that becomes a little bit more precarious than how do I make these little changes so that this way I'm on target versus when do I get in? I got FOMO. Put my money to work, baby. Let's just jump in. And typically when that happens is when you've watched it go so far that behaviorally you start to get anxious, like you're going to miss it, but you probably waited too long.
Yeah. But I think also another thing to think about is, we often find people calling us to reduce equity exposure as an emotional response to a decline. We haven't had a decline. The markets are relatively high. Actually, not relatively high. They're at all-time highs. Let me change that comment. And
Friday was a good decline, right? I mean, Friday we had
right, but what that means is it's also a really, really good time to gut check if your equity exposure is at the right level for your appetite for volatility. Because as much as we may have optimism about what's going to happen in the economy is doing really well right now. We think it will continue to do really well. And that's not because of or in spite of, it is just because the economy is a very slow moving ship and it doesn't tend to turn on a dime. So it's likely it will continue on its path. And that means things and the sentiment in the market is generally positive. So we would say in the short term, we don't have a reason to believe that markets will turn on a dime and reverse, but the risk is there. And if I had to just bet a dollar, I would say we're going to see more volatility going forward because of the uncertainty around these potential programs and campaign promises, and whether
Listen, we don't even have the cabinet. We already have arguments about cabinet appointees and whether or not the Senate's going to pass it. I mean,
I
there's
thought we
so
promised.
much
I thought we promised we wouldn't talk about cabinet.
I'm just saying there's so much craziness ahead. Like, yeah, I'm not taking your dollar bet because I'm kind of gonna. You know what? I'm gonna double down. I'm putting a dollar on the back of your dollar.
Well, I think at the end of the day, this is going to be. I think I've said this has kind of become the number one reality TV show in the world. If there's one thing that we do know, Trump likes the spotlight. He doesn't like other people to have it, and so we are likely to have his name in the headlines, and that might mean that sometimes, and this is something that Bobby and I used to talk about when, in the last Trump presidency, is you almost had to wake up every day at 5 o'clock in the morning and see what might have been tweeted because markets didn't know how to respond to it. I hope that markets are more mature in how they respond to some of these things going forward because it's quite a news cycle.
But we're ready. It's going to be fun. Come on, let's go get it, guys. We're going to do it. It's going to be great. Listen, we made it through those 4 years, and we made it out of those 4 years, I think, in a really healthy spot. And I'm saying us. I'm saying, us in general. And I think that us as we're still here as a country. We're still going to be here as a country. And, if we're not staying optimistic or at least aware of what's going on and trying to stay optimistic, it's a long haul. Pessimism and being a bear is a tough life to live.
I think
working everywhere. Somewhere.
I think there's a lot to still be reported on. I think we'll see where things go. We want to really thank everyone for coming on today and participating in this webinar. Obviously, the news flow is not going to stop. There's going to be a lot of questions that people have, and we just want to encourage people to just reach out, ask the questions when they come up. If you see a video clip, if you see a piece of news, you see something that makes you wonder, hey, do I need to worry about this? Do I need to make a change as a result to what's going on here? We welcome those conversations. Those are not things that that by any means we don't want to engage in. Have those conversations, make it part of our next commentary, make it part of our next webinar, help, kind of just hearing what people are hearing, because as we just said, the news cycle is overwhelming. We know the news outlets that we're looking at, but we don't always know the news outlets that everyone else is hearing or what's connecting or what isn't to investors' minds. So we welcome your guys' insight and what you're seeing. And like we said, it's about staying observant for us. So, it just helps us.
I'd also say turn to the next page of the news because there's some amazing stuff happening in science and in health and in development. It's unbelievable. You just got to get past all of the fear-invoking stuff. And there's some really good stuff going on.
That doesn't get as many clicks though, Bobby. You know that. Come on. It's all about the clicks. All about the clicks.
Listen, we could cure cancer tomorrow, and guess what's going to be news?
Yeah.
The cabinet picks.
Cabinet picks.
Yeah, feel free to reach out, guys, to team@GR Wealth Plan if you have any additional questions that come up, or if you want access to any of those videos that we showed clips of today, or the commentary that we put out last week.